everyone, I'm Jackie Smith with the Intentional Endowments Network. We welcome you all to the Proxy Voting and Shareholder Engagement for Endowments webinar. Before we get started, I want to mention that all participants are on mute, and we encourage you to send questions via the chat function throughout the presentation, and we will compile them and get through as many as we can at the end for a moderated Q&A. The webinar will be recorded and then distributed to all registrants via email and will also be available on the Intentional Endowments Network website under past events. Today we'll be discussing an overview of proxy voting and additional forms of engagement for endowments that are involved in commingled funds through an outsourced CIO. This will include the current landscape, trends, specific issues, and why it is important for investors. Speaking on this topic are Heidi Welsh, Executive Director of the Sustainable Endowments Institute, Natasha Lamb, Director of Equity Research and Shareholder Engagement at Arjuna Capital, and Tim Smith, Director of ESG Shareholder Engagement at Walden Asset Management. They're experts in the area, and we encourage you to go to our website and read their bios. Before we dive in, I would like to give a brief introduction to the Intentional Endowments Network for those of you that don't know us. We're a broad-based collaborative network advancing intentionally designed endowments through a variety of strategies, including ESG integration, impact investing, and shareholder engagement. The Intentional Endowments Network engages key leaders and stakeholders in higher education, business, and nonprofit sectors. It provides opportunities for education and training, peer networking, convening, thought leadership, and information exchange. And with that, I will hand it over to Heidi.
All right. Hello, this is Heidi Welsh. I'm with the Sustainable Investments Institute. I hope everybody's having a nice lunch. All right. I wanted to give you first an overview, a sort of context of where things have been for the last few years with respect to shareholder resolutions, give you some 2017 stats, and give a shout out for the more detailed discussion of the proxy season that we're going to be doing on March 8th. In the proxy preview report. That's going to be a pretty robust report explaining what's going to happen in shareholder season this year, and you can download it for free from proxypreview.org. Next slide. All right, so here you can see the shareholder resolutions on environmental and social issues that have been filed since the turn of the decade. And you can see there's a big orange bar in the middle, which is social. That includes the all the things that have had to do with corporate political activity, both election spending and lobbying. That really took off after 2010 and Citizens United. The blue bars on the top are what we call sustainable governance, sort of how the company is set up to deal with environmental and social issues. And on the bottom, that green bar having to do with environmental issues. These are somewhat fluid categories, and they often cross-reference each other, but this gives you a sense of how things sort of are divided up for the proxy season. Next slide. Now, for some of those that are not too familiar with proxy voting, I'm using this to illustrate what happens after a resolution gets filed. It doesn't mean that if you file a resolution, it's necessarily going to be considered at the corporate annual meeting and voted on. A lot of the action happens outside of the annual meeting when proponents and companies negotiate, usually about disclosure, and then they come to agreements, and that results in withdrawn proposals. Those are illustrated here in green. The number that are voted are in red on this chart, and the ones that are omitted are in blue. Now, omitted means that the company went to the Securities and Exchange Commission and challenged the admissibility in the proxy statement of a shareholder resolution under the provisions of the shareholder proposal rule. And if they are successful, the companies in that effort, the proposal gets omitted. Tim is going to talk briefly later on in the webinar about a new proposal from the Business Roundtable, which would significantly tighten up, if enacted, the provisions of the shareholder proposal rule, which could make it harder to file proposals and also more difficult to be a proponent and to get through all the thicket of SEC regulations on the subject. For 2017, as of these figures are as of mid-February, we had about 341 proposals that looked like they were going to go to votes. That number is going to go down, but the other thing, as withdrawals occur and omissions happen, the thing to notice, though, is that the number of withdrawals has actually been dropping in the last couple of years. I noted this back in 2015. It had sort of kept even with the previous years, but then the trend has reversed. And last year there were a lot fewer resolutions negotiated away. I think that's probably because things have gotten a little more fraught between proponents and companies. The vote numbers are going up as well a little bit. Go to the next slide, please. So here you see the overall average, that's the red line on the top, has sort of gone up a little bit, and it got up and down a little bit, but average is about 20%. But and then the number of votes has really increased, and that makes sense. If fewer are being withdrawn, then obviously more are going to go to votes, as long as the withdrawal or the omission rate is about the same. But what this chart here obscures is that there's a greater number that are actually getting, say, 30, 40%. And last year there were quite a maybe half dozen or more that actually got a majority vote, which is significant. Even getting 20% is significant, and something that management has a really hard time ignoring. Next slide. So this digs in just a little bit to what the 2017 proxy season is going to look like. About 20% or so have to do with political activity that is both dealing with election spending and also lobbying. And lobbying is actually a bigger deal now than it was in the past, and more shareholder resolutions are proposed on that subject. With the environment, that covers everything from climate change to environmental management things such as nuclear waste, although there's not much on nuclear. This year there are quite a few resolutions having to do with carbon accounting, and there are quite a few also having to do with methane leaks. That's come up recently with a big focus on U.S. oil and gas from shale deposits. There are fewer resolutions this year on renewables than last year, but there are a couple new ones on high carbon asset divestment and also carbon finance risks that are connected with the Dakota Access Pipeline and connecting to human rights and indigenous people's rights. And that's certainly a hot topic for a lot of folks. With respect to labor and human rights, that is split evenly. We put both sort of equal employment opportunity resolutions as well as sort of other human rights things in there. And a big focus this year is on the Israeli-Palestinian conflict. A lot of, obviously, clear conflict on that issue. Sustainability is mostly about sustainability reporting, and there are also some about linking executive pay to environmental and social issues. Overall, there are pending as of mid-February, like I said, about 340, and about 430 have been filed. Next slide. So I don't want to go over my time, but I just wanted to look really quickly at two issues. So climate-related proposals, as you can see, there have been quite a few more going to votes. That's the blue bar here. And the number that have been withdrawn is going down. Again, I think the requests are more difficult than in the past. Companies may be digging in their heels a little bit, and proponents really want them to do more, which makes sense in the context of the climate change crisis. Next slide. And then the other thing that's a really remarkable development, I think, this year in particular, is the big increase in economic equity proposals, asking for not only equal employment opportunity, but also pay equity and gender pay equity. And Natasha has been a big player in that. And last year they got a majority vote at eBay, and there were a bunch of resolutions in the tech sector. This year the lens, or the focus, is moving to the financial sector, and there are quite a few resolutions on that. But if you can see from this bar, there's a lot more this year than ever before on decent work and decent pay. And I think that about wraps it up for me, but I'll be happy to participate in the Q&A.
Thank you, Heidi. And now we will hear from Natasha Lamb.
Hi, good morning, or good afternoon to those of you on the East Coast, and good morning to those of you on the West Coast. I'm very happy to be speaking with all of you today, and I appreciate the invitation. Heidi, that was a great overview of the season, as well as past trends, and I think, you know, where I'll start today is talking a little bit more in the weeds. I started working on corporate engagements in a meaningful way about 5 years ago now. I had grown up on financial analysis and sustainability analysis, and then in 2012, decided to shift part of my focus towards corporate engagements. And so I'm going to bring you through some of the highlights from the 2017 Proxy season from the Arjuna Capital perspective. We filed 21 proposals this year. I'm going to talk a little bit about how we think about our engagements with companies and some of the emerging issues that we're working on. So next slide. So Ernst & Young asks whether activist shareholders are disruptors or advisors. And one of my good friends at EY tells me that they're referring to the likes of Carl Icahn, and that this doesn't apply. But actually, I think there are a great many corollaries between the work that sustainability-focused investors are doing, and in terms of influence, albeit with a greater environmental and social overlay. So, when it comes to the question of whether activist shareholders are advisors or disruptors, I would offer that they're both. And as advisors, activist investors can raise, many of the critical issues that Heidi mentioned, which highlight these unmanaged risks and opportunities. And if boards are not receptive, activist investors can assume a more disruptive role, and they can circumvent management by going directly to the company's owners, that is, to its shareholders and investors. And shareholder proposals are really kind of the sharpest arrow in the activist quiver. These proposals are placed on the ballot for a vote at the company's annual meetings. And whether or not these are advisory or disruptive, I think most importantly, they're catalytic. Next slide. So a catalyst is a substance that speeds up a reaction, and you strike the chemical at the end of the match to start a fire. And so the catalyst plays an important role in change, and particularly the speed of change. And I'll go through some examples of how investors can kind of speed up this social change. Next slide. One thing that's very important to recognize, and it's central to our engagements with companies, is that you need to come from the perspective of engaging a corporation so that it will act in its own enlightened self-interest, so that it will create shared value for companies, for employees, for customers, for the environment, and for investors. And if change can actually create more opportunity and less risk for the company while improving the lot of people and planet, then everybody wins and shared value is created. Next slide. So, as Heidi highlighted, activist investors have been pressing for positive change on social, environmental, and governance performance for decades. And what we've found through study upon study is that it pays to do so, and that companies who are managing their sustainability performance well have been shown to improve their financial performance. A few years ago, a Harvard University study came out that showed high sustainability firms outperform low sustainability firms on a host of metrics, including return on equity and stock price performance. And this graphic just shows a meta-study from Deutsche Bank, which compiled over 2,000 separate studies and showed an overwhelming benefit from investing in companies with strong environmental, social, and governance performance. So again, this illustrates that concept of shared value. Next slide. So with shared value as the lens, I'd like to take you through some case studies in active ownership. All of these are areas where we've worked to pioneer shareholder campaigns and have had different levels of success and certainly different forms of success, particularly on methane emissions, carbon asset risk, and gender pay equity. And I'm also going to talk about some of the issues that are emerging this year and where we've filed proposals for the first time. Next slide. So this is a very similar chart to the ones that Heidi has shown, but I want to start with this kind of overarching theme of climate change. And that is an area where the activist voice is certainly rising, and the number of shareholder proposals that are filed each year has grown nearly sixfold over the last decade. Of course, some companies are more receptive than others on this issue, but what we do know is that change happens regardless. Next slide. So first I'm going to talk about methane. Methane is an area where in 2012, when I was at my previous firm, I filed the first shareholder proposals on methane at 3 natural gas companies. And it was a time when, everybody was starting to question whether natural gas was better than coal from a climate change standpoint. As you know, natural gas burns more cleanly than coal, about half, twice as cleanly, or it's 50% more efficient. So there were really 2 issues at stake, not how it was burning, but the fact that when it was being flared and wasted, just basically burning off your product because there was the lack of proper infrastructure and poor regulation. And then the larger problem of leaking gas from unburned methane. And methane has about 84 to 86 times the global warming potential of CO2 over a 20-year time period. And so it's really kind of a climate change bomb. And the fact of the matter is that nobody knows how much is leaking. At least industry estimates seem to highly underestimate how much is leaking. And actually just this October, Nature came out with a study, or they published a study showing that methane emissions from the oil and gas sector are 20 to 60% higher than previously thought. And that's from actually measuring isotopes in the atmosphere, and they can link those directly to oil and gas. What we also know that about $30 billion worth of gas was leaked in 2012 globally, that this is really a business issue. It's a regulatory issue. The EPA has since stepped in and started to regulate methane with a goal to save 11 million metric tons by 2025. And so since we started this campaign, it's something that has, I think, really taken off. There's a clear business case for change. The second year we filed 3 proposals. The first year, the second year, I believe there were 12 to 15 proposals filed, and it's been about that for the last 5 years. And the pension funds are involved. These proposals get very big votes from institutional investors. Next slide. The shift that certainly happened for us this year is that it's not only about these small leaks that go unseen from the time you drill a well until you combust the gas and all across that value chain. It's also about the storage facilities, and Alyssa Canyon really highlighted I think a third risk in this campaign. You've got the flaring, you've got the leaking, and then you've got these giant methane storage facilities like the one that blew out in LA County, where 100,000 tons of methane was released into the atmosphere. And those storage facilities, there's about 400 of them across the country. 80% of them are located basically in depleted oil wells, and then they fill them with natural gas. And in this case, the casing failed. But so we've started to engage with companies on how they're dealing with this storage risk. We're engaging with Dominion, which has the 3rd largest volume of gas stored in the country. Engaging with Berkshire Hathaway, which very strangely has a lot of gas. There's another investor. Engaging with Kinder Morgan. We're engaging with Southern. And I think this really kind of brings a little bit of a new focus to the methane campaign. Next slide. So next I'm going to touch on carbon asset risk. This is an engagement that has evolved over the years. In 2013, we filed the first carbon asset risk proposal with ExxonMobil. And at that time, as we rolled into the spring of 2014, and they challenged our proposal and then lost at the SEC, we were able to negotiate a report on carbon asset risk. Basically, what's the risk to their reserves, given that we can't burn 2/3 of those that are booked on the balance sheets of oil and gas companies without inciting catastrophic climate change. And Exxon really appeared temporarily receptive. And I'm going to use this in this case study to illustrate the different ways that engaging with companies can have an impact. And it's not always changing the company itself. It's about also changing the conversation, the political atmosphere, how these issues are being viewed by the public. So we asked them to write this report. They did so, which was a big deal, but within it they outright denied any risk. And that in and of itself was fascinating. And we filed this proposal not only because our investors see the writing on the wall and the really unacceptable toll that climate change will take, but also because we see that Exxon is on a fool's errand. And if you look at the past decade of historic spending, looking for more oil we cannot burn, the impact to the company has been returns at historic lows, profitability has been cut in half, and risk is at an all-time high. Next slide. So it really makes sense for the companies to change course and for Exxon to start protecting investor value, not chasing untenable growth. But if they don't see the risk, then I think it's hard for them to move forward through time and make smart investment decisions. And our engagement has not been a success in a classic sense, and that's because at the company it really falls on deaf ears. And even after reporting or after the report resulted in in an investigation from the Attorney Generals of New York, Massachusetts, and California, as they've been looking not only at past climate change denial, but the information and the claims that they made in that report. The company continues to deny that climate change will have any impact on its business. So last spring, we actually asked the company to reassess its business plan, mainly how it spends its profits. We proposed a new path where shrinking, instead of growing the asset base, would actually boost profitability and create more climate change resilience, and as a result, bring more value to investors. But that proposal only got a 4% vote. So, maybe that's an area where we're over our skis. But I think it also, the proposal fell on deaf ears to institutional investors as well. It seems not to matter that the Financial Times and Chatham House, which is the second top think tank in the world, have proclaimed that shrinking profitably is the only viable path for big oil. The market continues to be keyed up for growth and not protecting value. So this year we're refiling that proposal, asking them to return more money to shareholders rather than invest in high-cost, high-carbon projects. But our clients have actually filed a second proposal as well, saying, what's your transition plan and how are you going to transition to a low-carbon economy? Because if you're not going to shrink profitably, then you need to figure out another way to do it. Next slide. So a more promising engagement has unfolded over the course of the last 2 years. First with eBay and then with 8 more tech firms, and it has since evolved, as Heidi alluded to. We filed the first gender pay equity proposal with eBay in 2014 and asked them to report on and close the gender pay gap. And when we did that, their board opposed us. Again, you have this issue of the proposal falling on deaf ears, which, in many ways doesn't make sense because, the case that we were making is, if you want to encourage diversity and attract, retain, and move up the ladder top talent, including women, then you need to remove the structural barrier of any kind of a pay gap. And so there's a clear case to do it. But the first year, this proposal only got an 8% investor vote. And I think it was pretty fascinating what happened over the course of the second year, which was last year, because as we started, we filed it with eBay the first year. The next year, we filed it with 8 more of those big tech firms, and as Intel and Apple and Amazon and peer firm after peer firm started to engage with us rather than oppose the proposal, investor support actually grew, and firms like ISS and Glass Lewis saw that there was a business case to be made and that it was a competitive issue. The companies that were being transparent and accountable to investors on this issue were also able to attract and retain top talent. And this spring, 51% of votes cast at eBay's annual meeting were in favor of paying women a fair wage. And that very day, the CEO committed to fix the problem, which was very exciting. Next slide. So this year, we're starting to expand the campaign, and there's a number of other groups and investors that are doing so along with us. We are looking at the big banks. It's another really male-dominated field, and asking, companies like Bank of America and Wells Fargo, JP Morgan, Citibank, Amex, MasterCard, a number of them, to report on and commit to close the gender pay gap. And we're still in dialogue with those companies, and we'll see how it goes. But I think the same case that we made with big tech firms, the fact that more diverse teams create more innovation and better financial outcomes, works well across sectors. And I think all sectors of the economy can be engaged on this issue. Next slide. So I'm just going to touch on a couple emerging issues that we've started to engage on this year. Obviously, everybody on the webinar has followed the really tragic disaster that happened in Flint in terms of lead poisoning from the city's water and mismanagement around that. And it's really sort of been thrown into the headlines over the last year. But one thing that I think people don't understand as thoroughly is that water is not the #1 cause of lead poisoning, although it's incredibly important to recognize that risk. But the leading cause of poisoning is actually lead paint and dust. And 35% of U.S. homes have lead paint, and it's this pernicious cumulative toxicant that for children under 6 can have really tragic on their development and lead to all kinds of negative outcomes like autism and behavior issues and ADHD and on, and aggression. And so this is something that we're kind of keenly aware of, and this year started engaging with Lowe's and Home Depot on the issue. Home Depot this year paid a fine, this in 2016, a fine for not having their contractors certified or mismanaging lead, dust, and debris during home renovations. And a couple of years ago, Lowe's actually paid a record-setting EPA fine for the same thing. So it's both there's both a regulatory risk there and a litigation risk, but I think more importantly, both of those companies sit at the nexus between where contractors and do-it-yourselfers are, going to buy products and then renovate the built environment, much of which has lead paint. And it's not just the dust, or it's not just the chips on the window. It's it can be, you knock down a wall and you have no idea, it's an invisible problem. So that's something we're engaging with right now. The companies are challenging the proposals at the SEC, and we'll hear shortly on that. Next slide. Fake news, also something that's been in the headlines and that has an enormous sort of impact on our democratic process. Is something that we've also been engaging on with both Facebook and Google, and asking them how they're dealing with the public policy issue, the fact that in Germany and France and the UK, those governments have already gotten involved, have threatened fines against Facebook for not taking down fake news, the companies really haven't addressed the censorship issue around it. They haven't addressed how changing an algorithm could lead to censorship. They need to think about free speech rights. And then there's the reputation issue. And I don't know about you, but I have a lot of friends that after the election, everybody was saying they had Facebook fatigue. And is this real? I don't know if this is real in terms of what's posted on there. And the fact of the matter is that Facebook is not infallible, and people can move on to the next thing. Most people don't get their email from AOL anymore. Nobody's on MySpace, and so it's something that the companies are going to have to address in a very thorough and thoughtful way over time, because this is not an issue that's going away, and it's being politicized, and it's an area of I think quite high risk for the companies involved. And that's it.
Thank you, Natasha. Just as a reminder, please enter your questions into the text box in the chat function. And now we will hand it over to Tim Smith.
Good morning. This is Tim Smith from Walden Asset Management, and I'm very, very pleased to be part of this call with really two outstanding leaders in our field. Heidi, as you've heard, is a guru with an indispensable reservoir of data and analysis on proxy resolutions, very important research firm, SI2. And Natasha is a leader in cutting-edge work with companies, as you've heard her speak on a number of future-looking issues. I'm going to do something a little different. I'm going to talk about four connected but somewhat different messages for this discussion, and then we'll open up into questions, answers, and discussion. The first is our right to file resolutions, and Heidi mentioned this quickly. They are under attack. The second is the importance of us getting involved in this proxy season, and how do we do it? Thirdly, I want to just highlight the important role of the Department of Labor in providing new guidelines to us that buttress and protect shareholder resolutions. Awfully important, I think, for the university and college community. And finally, I think you'll be interested in particular resolutions urging major firms like BlackRock and Vanguard and Bank of New York Mellon to vote their proxy. So this is proxy season. We're focusing on that. Jackie's going to be a timekeeper and will crack down on me. So the first point, last week, the Business Roundtable wrote Gary Cohn, the director of the National Economic Council, and highlighted 16 regulations for priority attention. Among them were changing the shareholder resolution process. And this has been an ongoing campaign. Actually, Heidi will remember, it goes back decades and decades. But every 10 years or so, there's a very serious attempt to shackle those who are filing shareholder resolutions. Commissioner Gallagher of the SEC said it very starkly 2 years ago when he said special interest groups had hijacked the proxy process. So that's the Natasha. That's the resolutions that Heidi's talking about. This is supposedly a hijacking of the process. And here's how the Chamber or the Business Roundtable said it last week. In too many cases, activist investors with insignificant stakes in public companies make shareholder proposals that pursue social or political agendas unrelated to the interests of shareholders as a whole. Well, that's quite a fantasy story, but and one we need to push back on. Of course, resolutions are filed some by individuals, but many filed with institutions with literally trillions and trillions of dollars of assets under management. And many of the pension funds are under legal obligation to make sure that they are raising issues that are important for the bottom line, the kind of thing Natasha talked about when she showed how there is a blended interest between shareowner value and social interest too. They are in the interests of shareowners too. We will argue that case vigorously. So today I'm not going to try to go into detail to refute them. I want to give an alert though to the IEN community and say that we'll bring back to you opportunities to join with other investors, religious groups, pension funds, foundations, and so on, who will be responding to this rule change. Our concern is the proposals by the Business Roundtable and the Chamber would be death by 1,000 cuts. So that's point one. Two, what's the importance of getting involved? Well, this is proxy season. We always in proxy season urge you to vote thoughtfully and conscientiously on the resolutions that Heidi is mentioning. And some universities and colleges have the ability to have separate accounts whereby they can vote the proxies or tell their managers how to vote. But increasingly, we see people who are in mutual funds or commingled funds urge these funds to vote for shareholder proposals on environmental and social issues. And I'm going to suggest that those funds are listening more carefully to their owners. An example today of the fact that I think major institutions are listening, Fidelity just joined the Principles for Responsible Investing, and Vanguard and BlackRock are expanding their ESG staffs. So it's hard work to get them to change their proxy votes, but not impossible, as I'll mention in a little while. So let companies know you care, too. There's two ways that I'm going to suggest you might consider do that. The Principles for Responsible Investing is setting up a new website. You don't have to be a member. And you can declare how you're going to vote on a number of shareholder resolutions. So you could actually do a big job and say, okay, here we're going to publicize our whole portfolio. Or you could choose 10 companies and say, well, we're going to declare on them. Likewise, one could decide to send a letter to selected companies. It could be on gender pay equity. It could be on climate. You could write Exxon in support of one of the resolutions. But it's important for you to have an opportunity to participate this year. Thirdly, the Department of Labor. I mentioned that in December, in its final days, the Department of Labor provided new guidance. And it was guidance on proxy voting, updating and taking away what we call the chill factor of the guidance provided under the Bush administration 8 years ago. This is terribly important for ERISA funds, but also for other big institutions who watch what ERISA funds, how they're guided and what their checks and balances are. So this guidance affirmed the responsibility of fiduciaries to vote their proxies, something we're talking about today. It eliminated some of the fear. For example, the Bush administration basically said you had to have an economic case for every single vote. Well, that was a little bit chilling. So this step was very important. And I know, Jackie, that you have other materials that either are on or will be on our website. So anybody interested in the Department of Labor guidelines, there's much more meaty materials there. Last point I'm making is an interesting one to close on in proxy season. It's about resolutions and appeals to major investment managers, to vote and to vote in favor of resolutions like climate change. So every year, Ceres, which some of you know, I think, well, it's this Coalition for Environmentally Responsible Economies. They do a press release and a research which highlights how institutions vote on climate. So it shows the bottom of the ladder: Fidelity, Vanguard, BlackRock, Bank of New York, JP Morgan, always vote against every single environmental and social issue. It's absolutely shocking. Whereas other companies like Goldman Sachs or State Street vote for a reasonable number of them. So I'm just going to suggest that this is a year where there's a huge change in context for this discussion. There's more press attention. Competitors are changing. Both State Street and Northern Trust, to name two, have changed their proxy voting from a couple of years ago, where they were also at the bottom of the ladder and voting quite vigorously. The Principles for Responsible Investing, of which many groups like Vanguard and today Fidelity joined, is urging its members to look at their proxy voting. And then there's even pressure from some clients. I know one major investment house lost a $200 million account, or part of an account, because of their proxy voting. So that's hitting them on the bottom line. And finally, this year, there's shareholder resolutions. They've been filed with JP Morgan, Bank of New York, T. Rowe Price, Vanguard, which is a mutual fund. We'll talk about that in a second. Franklin. And good news to report is we have had agreements with negotiations and agreements with BlackRock. We've actually withdrawn the resolution and they will be making a major statement about the importance of proxy of the importance of climate change to climate. Sorry, I'm going to say it again. The importance of climate risk for investors and how they're going to engage companies and hopefully start voting too. So I think it's awfully important if you own shares in these companies to let them know you're watching how they vote. It matters to you. They represent you. And especially if you are a client of some of these companies, we can get you the series report, Jackie, and make it available to you. So here's 4 things that we thought were important to end with, and I'm glad to turn it back to Jackie for discussion.
Thank you, Tim. And the resources that Tim is referring to is available on the Intentional Endowments Network website under the resources section. So now we will open it up to Q&A.
And Jackie, if it's okay, I'll just take a crack at the logical next step from what I had been talking about. There's a question about what can institutional investors who outsource proxy voting to external managers do to ensure their votes are cast in long-term interests of their beneficiaries. So I think the most simple thing is you have the right to ask for your external managers to report to you how they voted and why. So yes, you've outsourced that function, but you haven't necessarily outsourced the responsibility. And increasingly, such investment firms are hearing from their clients. So I would encourage them to do that, maybe have a little discussion about why they aren't voting if they're really at the bottom of the ladder. And of course, some institutions have even taken their proxy voting responsibilities back because they're so unhappy with what their external managers do. I hope that helps.
This is Heidi. If I can just weigh in on the issue of proxy voting, I think there was a question about why do some managers do it more than others. I think one driver for more focus on proxy voting is the increased acknowledgement among big mainstream investment managers that climate risk is real and that they need to attend to that in their portfolio companies. And so they are looking pretty carefully at the reform proposals that are coming up in shareholder resolutions. They are pushed to do that in some part by not only the risk issues, but also because those have been sort of codified in the effort called the Principles for Responsible Investment, which came out of the UN, which is trying to sort of push sustainability management and action into the investment chain. And there are, I can't remember how many trillions are signed up to that at this point, but investment professionals and managers who sign up to that have to sort of show the money every year in their reports on how they're doing on the key principles of the Principles for Responsible Investment, and one of those is proxy voting and corporate engagement.
Thank you. And we have a question for Natasha. Given the recalcitrance of Exxon in even recognizing the impact of climate change on their business, would Arjuna consider divestment from the company? And what are your thoughts on the divestment movement generally?
Thank you, Jackie. I mean, I think the divestment movement, although it started from really, I think, a moral argument that, you know, we're going to destroy the world with climate change. I think that the financial argument is not far behind. And, you know, I alluded to what's happened to Exxon and its peers over the last decade as they were looking to chase kind of the you know, more and more oil, and that became a more expensive endeavor. So, you know, you can think about two constraints that are facing the oil and gas industry. The first one is, you know, there's only so much carbon that we can pump into the atmosphere without catastrophic climate change, and there's only so much easy oil in the ground. And what happened over the last decade is that companies start, in order to kind of keep up this facade of growth, started looking for oil, in oil sands and in ultra deep water and in the Arctic, pre-salt layers of the Earth's crust. I mean, those are enormous, expensive engineering endeavors. And, as I said, profitability has been cut in half. Risk is at an all-time high. And when you start to look at what companies are doing moving forward, in the case of Exxon, they don't really at this point seem to be pivoting despite all of the mainstream pressure to do so. And probably pretty soon they'll be back in the Arctic in Russia if sanctions are lifted. And I think that was like a $500 billion deal that was shut down in 2014 because of the sanctions. So I can't say that investing in big oil, if it doesn't change course, is a good idea moving forward. I think a lot of money has already been invested and wasted, and when commodity prices went down in terms of the oil price, those companies were really hit. And I had a big oil major admit to me a month or two ago that that they wouldn't make that mistake again, but of investing in these really high cost projects. But we'll see. So I think the business case is with divestment. We've hoped for change at the companies, and we'll continue to press for change. I don't think that that engagement and divestment are necessarily mutually exclusive. We've got a lot of clients that have divested from fossil fuels. We have other clients that want to use their shares and engage for change. And I think it's a combination of both, and a false choice that you have to choose one path over the other.
This is Heidi. I just want to weigh in a little bit. I think what any sort of question about divestment begs is what is the ultimate goal of the action? And are you looking for purity? Are you looking to mitigate risks? Are you looking to sort of find and exploit opportunities? How are you doing? Are you doing that at the right time, which is always the question when it comes to investment? And how are you doing this in a really complicated environment? And I think what happens with shareholder resolutions is that they reflect sort of the general sense of the time, whether it be sort of racial equality issues or climate change or whatever. And there are a lot of different types of shareholder resolutions out there that take different pieces of this. So I guess I would say, from my perspective, divestment seems to be a pretty blunt tool. We don't do investments at SI2, and we don't provide investment advice, but we try to look at the sort of big context of what's happening and what people are asking companies to do. And they're asking companies to do a lot of different things. And the shareholder resolutions, I think, are reflective of a range of different options.
I'll add one point there. I think it does matter when you have investors with literally trillions of dollars of assets under management who are pushing companies on things like the transition plan. I'm thinking of the oil companies that Natasha was speaking to too. And last year there were resolutions. One, Occidental Petroleum got 49%. So you can see that that's really sending a message that even mainstream investors are backing this. Having said that, I think we all need to be very careful not to overpromise the impact that we've been able to create through shareholder engagements with major oil companies. This is the Titanic, or not the Titanic necessarily, but the ocean liner, the oil liner, trying to turn around, and it is really hard, slow work. So I'm glad, as Natasha said, that there's both investors who are actively divesting and sending a moral message, but I'm also glad that some of those who haven't chosen that route are actively involved in petitioning, pressing, pushing companies.
Thank you. As you so reported that the 100 most overpaid CEOs at S&P 500 companies underperformed the rest of the S&P by 3% over the past 2 years. What should investment fiduciaries do with say on pay and compensation committee member election votes in response to this?
So the simple answer, of course, because there is say on pay, which we got through Dodd-Frank and is on the most companies' ballots every year, is you get a chance to vote no on a pay package. And there are some institutions who vote regularly against too lucrative pay packages or ones that just aren't linked to performance. And then some, as you know, or as the question noted, might even vote against compensation committee members, saying you're the ones who brought this to us, and we think you haven't done your homework. They listen to that. The comp committees, I know, are very serious about those votes, and they'll come back to shareholders with different plans next year. So those are two routes to choose this proxy season.
Thank you. This one is student related. How can I work with students to create proxy voting guidelines?
Heidi, where would you point to a reservoir of model proxy voting guidelines? I guess one of the most important things is to say, well, what are some good models that you can point to, whether it's a state pension board or another college or university? And maybe, Jackie, we could be putting a few of those up on the website if we haven't already, to help people.
Yes, definitely.
Yeah, I mean, typically, some of the folks that I provide research to are some of the really big college and university endowments who have been doing proxy voting for a long time. And there are some of them publish information on how they vote, and Harvard has a regular report every year on how they voted and why they voted on resolutions that come up, and I think that's available on the web somewhere. I think there was an article in the Harvard Crimson that talked about how they voted. In terms of coming up with guidelines, usually that's a committee effort, as things often are with big institutions, and usually that involves a couple students, a couple faculty members, and somebody from the administration side who actually deals with investment management, either internally or often, and as is more the case these days, with external managers. So there are a bunch of models out there, and I think we have some resources on the IEN website that talk about how that can be done.
Thank you. So I think that's about all the time we had for questions today. If you have any additional questions, and for the ones that we weren't able to get to, please send us an email. Thank you very much for the panelists and for everyone that participated in the webinar. A few upcoming events that we have are Sustainable Investing Through Hedge Funds on March 9th. And on March 15th, research findings of mission-aligned investing, leadership, and decision-making process. And we will have another webinar later in March on intelligent connecting energy and the environment for the smart investor. Thank you again to all the panelists and participants. If you're interested in learning more or about joining or supporting the network, please send me an email or visit our website, www.theintentionalendowments.org. I'm sorry, there's no the, it's www.intentionalendowments.org. We also encourage you to stay connected with us by signing up for our listserv for updates. Thank you again, and have a great day.
Thank you.
Thank you.
Thanks.